What if I told you that the biggest threat to your wealth isn't the stock market crashing, a recession, or even bad news, but rather the person you see in the mirror every single morning? Because according to the single most important investment book ever written, the one thing that will destroy your finances faster than any market crash is actually your own emotions. Today, we are unlocking the timeless wisdom of Benjamin Graham's masterpiece, The Intelligent Investor. This is the book that turned a 19-year-old kid named Warren Buffett into the greatest investor in history. And within these pages lies a secret so powerful, so counterintuitive, that it has created more millionaires than any get-rich-quick scheme ever could. So, if you are ready to learn how to stop gambling and start building real, lasting wealth, stick with me for the next 5 minutes. We are about to change the way you see money forever. To understand the genius of this book, you have to understand the moment it was born. Benjamin Graham wasn't some academic sitting in an ivory tower. He was a Wall Street professional who lived through the single most terrifying financial event in modern history, the crash of 1929 and the Great Depression. He lost a fortune. And from the ashes of that loss, he developed a philosophy designed not to make you rich overnight, but to ensure you never, ever get wiped out. He realized that the stock market isn't some rational, calculating machine. It's a person, a very, very emotional person. Graham gave this person a name. He called him Mr. Market. Picture this. You own a small piece of a business. Every single day, without fail, your business partner, Mr. Market, shows up at your door, and he offers you a price for your share of the business. Some days, Mr. Market is euphoric. He's optimistic, he's happy, and he offers you an insanely high price, way more than the business is actually worth. Other days, Mr. Market is depressed. He looks at the world through a dark lens of pessimism, and he offers you a price that is ridiculously low, far less than the true value of what you own. Now, here is the million-dollar question. Do you listen to him? Do you let his mood swings dictate how you feel about your business? Graham's answer is a resounding no. Mr. Market, he says, is there to serve you, not to guide you. You are free to ignore him, or you can do business with him when it suits you. But the moment you let his fear make you sell, or his greed make you buy, you are no longer an investor. You are a speculator. And there is a universal difference between the two. And that brings us to the absolute cornerstone of Graham's philosophy, the concept that Warren Buffett calls the most important thing he ever learned, the margin of safety. Imagine you are building a bridge. The engineers don't build it to hold exactly the weight of the heaviest truck that might cross it. They build it to hold 3, 4, maybe 5 times that weight. That buffer, that extra layer of protection, is the margin of safety. It's what keeps the bridge from collapsing when a storm hits or when something unexpected happens. In investing, Graham argues you must do the exact same thing. You must never, ever pay full price for a stock. You have to calculate what a company is truly worth, its intrinsic value, and then wait patiently until Mr. Market, in his depression, offers it to you for a fraction of that price. Maybe you buy a dollar's worth of assets for 50 cents. That 50-cent discount, that is your margin of safety. It protects you if you made a mistake in your calculations. It protects you if the market tanks. It protects you from the unexpected. Without this margin, you are not investing. You are hoping, and hope is not a strategy. Graham understood that the future is unpredictable. He knew that even the best analysis can be wrong. So he built a system that admitted its own fallibility. He built in a cushion. He said, the function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. Let that sink in. You don't need a crystal ball if you have a margin of safety. You just need patience. Now, Graham was a realist. He knew that not everyone has the time, the desire, or the expertise to dig through financial statements to find these bargain stocks. So he created a roadmap for two different kinds of people. First, there is the defensive investor. This is someone who wants safety and freedom from bother. They don't want to spend their weekends reading annual reports. For them, Graham's advice is beautifully simple. Diversify. Own a representative group of solid companies, or better yet, just buy an index fund and stick with it. Don't try to time the market. Use a strategy called dollar cost averaging, where you invest the same amount of money at regular intervals. Buy more shares when prices are low and fewer when they are high. It's a boring strategy. It is utterly unglamorous, but it works. And then there is the enterprising investor. This is someone who is willing to put in the work to try and achieve superior results. But Graham warns this person with a stark reality check. It is not easy. To be enterprising, you must be disciplined. You must be able to ignore the crowd. You must be willing to dig into the numbers, to look at companies that are out of favor, that are unpopular, that are ignored, because that is where the bargains are. He famously said, the intelligent investor is a realist who sells to optimists and buys from pessimists. In other words, you have to be willing to stand alone. And for most people, that is the hardest thing in the world. We are social creatures. We want to do what everyone else is doing. But in the stock market, following the herd is the surest path to the slaughterhouse. So, why does this book, written in 1949, still matter in a world of high-frequency trading, cryptocurrency, and meme stocks? Because human nature hasn't changed. Greed and fear are still the two most powerful forces on Wall Street. In the short run, as Graham put it, the market is a voting machine. It's a popularity contest. People vote with their emotions, buying whatever is hot and selling whatever is not. But in the long run, the market is a weighing machine. It weighs the actual substance of the company. It weighs the assets, the earnings, the dividends. And over time, the weight always wins. The intelligent investor understands this. They know that the price of a stock and the value of a business can be two completely different things. They know that volatility is not risk. In fact, to them, volatility is opportunity. When prices drop, they don't panic. They get excited. They see Mr. Market having one of his depressive episodes, offering them a chance to buy more of a good thing at a discount. They see the market's stupidity as their personal ATM. This requires a specific kind of character. It requires emotional stability. It requires the ability to detach yourself from the noise. Graham wrote, "The investor's chief problem, and even his worst enemy, is likely to be himself." The biggest battles in investing are not far on the floor of the stock exchange. They are fought in the quiet of your own mind, when the news is bad and your heart is telling you to run. So, as we start to wrap this up, I want to leave you with the core lesson that encapsulates the entire book. Benjamin Graham didn't care about predicting the future. He cared about surviving it. He didn't care about being right today. He cared about being right over the next 20 years. And the path to that long-term success is deceptively simple. Treat the stock market as if it were a moody business partner named Mr. Market. Never let his emotions become your emotions. Always insist on buying with a margin of safety, so that even if you're wrong, you don't lose your shirt. Decide whether you are a defensive investor who will be happy with average returns, or an enterprising investor willing to put in the work for above-average returns. But whichever you choose, stick to your strategy with unshakable discipline. The Intelligent Investor isn't really a book about money. It's a book about character. It's a book about patience, about humility, and about the courage to think for yourself when everyone around you is losing their mind. It teaches us that real wealth isn't built by hitting home runs. It's built by not striking out. It's built by showing up day after day, decade after decade, and letting the power of compound interest work its magic. Warren Buffett once said that his investing philosophy is 85% Benjamin Graham. If it's good enough for the Oracle of Omaha, it's good enough for us. So, the next time you see the market take a nosedive, don't look away in fear. Smile and ask yourself, what would the intelligent investor do? Thanks for watching, and as always, invest wisely and invest with a margin of safety. If you found this breakdown valuable, please hit that like button and subscribe for more deep dives into the books that actually matter. I'll see you in the next one.